Hi everyone, this is Michael Bengiat with Lifetime Investor, and this is the Market Trend Advisory Weekend Review video for September 17th, 2022. Well, before we start, here's our disclaimer. You can pause the video and read it. And let's get right into the market trend. Well, this week we had a lot of deterioration. We ended up on Friday going back into a market in downtrend or market in correction. The system currently has no exposure. We haven't had for a while. We had a brief blip up last week where it looked like the markets were just going to take off again, and that all reversed. And so we are basically in solid red, and so you should have no exposure to the market, either with individual stocks or the indexes. It's really not looking very good for the market. For our investing strategies, the QQQ buy and hold is down over 27%. Our market count 1x strategy is down less than 10, so we're really beating it quite strongly there. On the S&P, I'm sorry, for the S&P, for the SPY buy and hold is down almost 19%. Our strategy is down 13.44%. So here's just a chart of the NASDAQ. You can see here we had this very strong rally going from July into August. And it ended up reversing. We had another few really powerful days last week and then going into this week, and then it all reversed on the hotter than expected CPI report. This is the hallmarks of a bear market. You get very strong rallies that look like they give people FOMO. We saw it over here, and we had 1, 2, 3, 4 days in a row. We've seen it other times here. This looks like, this is it. The market's going up, and it gives people FOMO. You have to just look at the market, unemotionally, and that will help you keep you out. Or use, our system, of course, only has us in when all the indicators and the institutions are all aligned. Now, we did get a little bit of a buy for a while there in the S&P especially, but it reversed pretty quickly. So we didn't have much exposure for long in the markets. But one thing we've been pointing out too is that, while at the same time, while we're getting these runs, we're just getting low volume. There's no institutional support coming in. If you just look at all the volume since this since the decline started, it's just really just a few days here and there. We get strong volume, but overall, it's just not giving you any signs that institutions are staying in there. Let's take a look at the S&P. S&P was classic. It rallied right up to its declining 200-day moving average, and then fell back straight through there. Just plunged straight through the 50-day, which is this red line. Again, we had these 4 days of just really strong days, just blasted straight up. This is where we actually got some buy signals, because now we are the low is above the 50-day and the 21-day. So we did get some buy signals there, but then it just very quickly reversed and had us right back out. In the NASDAQ, we didn't get as much because we had other sell signals going on, and that quickly reversed there too. So currently we don't have anything. The only thing I don't like what's going on, and just again, this is just, I think we're not near the bottom of this market anytime soon, is this buy the dip mentality. You can see it really strongly on more on this chart. We had a big decline in the open, and sure enough, by the close, we had just been rallying into the high of the day. Now this keeps giving people FOMO. You feel it going up here. I'm missing out. And here you just see the buyers just keep piling in, even though they're, especially on the NASDAQ, even though they've been piling in the whole way, and these stocks many of them are down, 50, 60 or 70% or more, and they just keep coming in. A true bottom isn't usually made until people just hate the stock market. They don't want anything to do with it. They are worn out. They've lost their money. It is just like, that's it. That's when the real bottom will come. And we are nowhere near that in terms of what the market's doing and how people are acting. So, and again, we're kind of supported we're getting all these people piling back into the market on the slightest dips. But just look at the 52-week highs. we're just routinely just swamping them, except for this one day here. I think every single day here is just the lows are beating the highs. Yeah, so that's, and we're seeing here the percentage of stocks of the 200-day. We're just at basically 1/4. So 75% of stocks are below the 200-day. There's no reason to be piling into the market all the time. Just in terms of the number of growth stocks, leading stocks that are breaking out, look, you can just see this has just been declining pretty much from about a month ago. And the up volume, just look at the up volume, just swamping 10-1 on the down volume, sorry, it's swamping 10-1 on the up volume. Here it was even worse. I mean, we were down at 0.04 ratio, 1,000 down to 45. So we're really not getting any signs that this is where you should be piling in and bottom fishing, but this is what people are doing. And I hope that's not what you're doing, because that's just a recipe for losing, pretty much all of your money. And in terms of market sentiment too, we got a little bit mixed picture. It is definitely moving towards bearishness, but really not anything yet to do with a real extreme. One thing about the markets, when you're in a bear market, you really need a lot more bearishness to get a bottom than just a standard pullback or a correction in an ongoing bull market. And we're just not seeing that yet. We had some at that bottom we had back here in June. We had some the bearishness got pretty dark and pretty heavy, but then it just meant, oh, that's why we should just pile all the way back in. But it's not lasting. And so you have to be very careful in these bear markets. They're designed to pull you in and basically take your money. So be very careful. Our system is basically pointing towards, which is comprised of lots of technical action on the markets, as well as what the big institutions are doing. And there's just no reason that you should be heavily invested, if at all, in this market. So I hope you're heeding the signs here in the service. So next week, the big meeting for the FOMC is on Tuesday. They're going to tell us what they're going to do regarding interest rates. We've talked about this all week. We had that hotter than expected August CPI report, and that really just killed the market. People thought that Powell was going to, sort of hand them a life preserver. He was going to maybe bring back the Fed put, where we've, the base of the Fed saying we've got your back, and he basically did none of that and went the other way, saying, sorry market, but we need to tamper down inflation, and if it's going to cause a recession and an extended bear market, so be it. So what's happened now is that now the market's looking towards a more aggressive Fed and a more aggressive Fed rate hike coming up on Tuesday. Hike, and a 17% chance that the Fed will boost a full percentage point, which is pretty much unheard of. See, part of the problem we have now is that if you look at all the Fed tightening cycles since 1973, the Fed central bank has never stopped tightening before the Fed funds rate was higher than CPI. We have a long way to go to get to that level, since CPI right now is 8.3%. And just recently, Ray Dalio, the founder of Bridgewater Associates, one of the largest hedge funds, he came out saying he's forecasting a rise to a range of 4.5 to 6%. From the Fed's sort of neutral range right now is 2.25 to 2.5. So he's looking towards another 20% downside. Now there's a lot of things that can go in this. We've seen recently a lot of billionaires and sort of famous money managers have been coming out really, really pretty bearish. Now they make good headlines, but sometimes what you don't hear is that when they turn bullish, they don't usually come out and say, hey, we've just reversed our course and changed that. So you got to take it with a little bit of grain of salt about what they say. But Ray Dalio has been doing a lot of really strong educational videos and things. So he's really on. You can find them on YouTube. There's some really great videos about how the economy works. And he's been calling for sort of the end of the U.S. empire and the rise of the Chinese empire. Really interesting videos and free books that you can find. So we don't know exactly what's going to happen. And part of it is that we don't know how, in terms of the stock market, how much has been discounted already. Some people feel that looking at the carnage in the NASDAQ stocks, especially, the market's done already a good job of discounting much of the bear market and much of this interest rate hikes going forward. But we don't know. And part of the problem we see is that how the Fed ends up raising rates and the speed of that they do it makes a big difference. So right now the Fed's moving at a really fast pace, and the market is discounting, looking forward, probably fewer and lesser rate hikes going forward. But we just don't know if there's going to be a major recession that will change the picture dramatically. So if you look at how, I don't have a chart of this, but if you see that when the Fed starts hiking and moving in an aggressive pace and a fast pace, we tend to get shorter recessions and shorter pullbacks. When it's been stretched out longer, we tend to have longer pullbacks and longer bear markets. So we don't know how that's going to play out yet. Now, just as a final thing on Tuesday, the market may continue to sell off if the Fed only raises by 75 basis points, even though that's what most people think it's going to do. The market really wants this to be over. That's what it's trying to discount, that all the bad news is out of the way. Most of the interest rates hikes are going to be done. And sure, it may have to work its way through the economy and through a session. But in terms of the stock market, it's trying to find a bottom, that this is it. And it may not go up immediately. It may just end up trading down in a range, maybe where we are now, maybe a little bit lower. Nobody really knows. But that's what the market's trying to discount. If they came out and do a 100 basis point move on Tuesday, that may give an initial shock of like, wow, this must be worse than we even think. But it may be actually very bullish for the stock market, and you may see a really massive rally if they do that, because again, the market's looking forward and is trying to see, can we get this out of the way sooner than later? Even though the market doesn't really know how that's going to be affecting everything, because at the same time, the Fed's pulling out a ton of liquidity, and we don't know at this point if the recession is going to be a bad one or a shallow one. Right now, it seems to be pricing in a shallow recession that's really not going to do a lot. Consumers seem to be spending. Businesses have been warning, but they haven't been seeing a lot of major signs, except FedEx's warning yesterday. So that's the big question. We'll see what happens on Tuesday. The 75 basis point may just continue another big sell-off, because it wasn't what the market really wanted to see. And the 100 basis point could be something that could trigger a rally, because it is more than the market thought and could be ending this cycle sooner than later. Well, that's about it for this week. We will be back next week, and we'll see what happens on this pretty momentous FOMC meeting on Tuesday. So just check our notes every day, especially after Tuesday when the market closes, and we'll be updating you of what's happening. Okay, thank you. I'll talk to you guys soon.